Today we have the pleasure of going over a mega portfolio from one of the biggest dividend YouTubers in the space today. We'll be going over my good friend Dividendology's entire $90,000 stock portfolio, going over all of his holdings, his portfolio income, and so much more. This is a series where I go over portfolios from my subscribers and other creators in the finance space. The goal of this series is to be introduced to new stocks, investing styles, and overall promote transparency. Dividendology is one of the only bigger finance creators right now that actually promotes transparency every month, so big props to him on that. If you appreciate transparency and you want to learn a whole lot about really valuation of stocks, I would recommend his channel and DIY Investor Spreadsheet. The link is in the description. And of course, roll the intro.
Hello, I like money.
Before I like to go into these portfolios, I really like to know more about the investor, what's their current situation, and what their goals are with the portfolio. So I asked Dividendology. He said he's in his mid to upper 20s right now, and he told me the goal is eventually to live off of the dividends through dividend growth, compound interest, and the dividend snowball overall. Me and Dividendology overall have a pretty relative same, investing mindset when it comes to dividend growth. Invest in high-quality companies that reward you as a shareholder through good dividend growth over time and eventually live off those dividends. Right now, his portfolio is sitting just over $91,000, which is incredible for your mid-20s. He's up just over $6,000 in gain, is currently up 7.1% on the portfolio. He's been making investing-style content for along the same time as I've been, so I'm just going to assume that we're kind of on the same time horizon here and that he's been investing for the last 5-6 years. 7.1%, I believe, is underperforming the market a little bit, which is in the kind of same boat as I am right now. As we'll get into these companies and you'll see why that underperformance may be happening. But we got to look at the total return because this is a dividend-oriented portfolio, and the total return is 12.78%, and that's much more like it. Right now, he's also got $19,000 in cash, which I commend. I wish I could do that. Also, as a viewer on his channel, I've also noticed that he's trying to be a little more conservative and patient right now. He doesn't see many great opportunities in the market, which I can totally understand. He's also got no crypto in his portfolio, so I'm a fan of that for sure. That's an extra 2 points on the overall grade. Right now, he's got 17.3% of his portfolio in cash, which again, I commend. I can never do that. Right now, he has 33 total holdings, which is a little bit on the higher side. It's around kind of where I'm at right now. So again, there's a lot of similarities between mine and his portfolio right now. He did say, though, in his portfolio update that he does want to consolidate this. I would assume that he also kind of fell into the diversification trap, which is something that I've been known to talk about a little bit on this channel. Diversification trap is essentially just buying okay quality companies just because they have a big dividend or just to diversify. Not because they're a strong company at all, just to get that diversification to a separate business or sector. He also has a future portfolio outlook in the bottom corner, and you can see that his reinvestment calculators have him coming at $280,000 in annual dividend income in 30 years, as long as he keeps on reinvesting his dividends in some of those higher growth positions. Alright, let's get into the actual holdings. We'll start off by the stock allocation by industry. Alright, to start off, we have ETFs making up 37.3% of the portfolio, consumer cyclical making up 6.2%, industrials at a small 1.7%, financials at 10.5%, real estate at 11%, 8.2% at consumer defensive, 3.1% in healthcare, nearly 20% in technology, and a whopping 0.9% in energy. Now, I would assume the underperformance obviously a little bit is because of that financials there. We'll get into that later though, and the real estate. Alright, let's move on to the bread and butter here, which is the holdings, of course, and this will be very interesting. Alright, let's start off with the elephant in the cage here, which is SCHD, making up 37.3% of the portfolio. Now, SCHD is obviously a very high quality ETF in my opinion. Very solid dividend income obviously coming from there. Not that I'm against SCHD or anything, but they are kind of underperforming this year, but long term they are pretty much in this same boat relatively in total return compared to the S&P 500. I'm not against this whatsoever, but here's what I think I would potentially do. I would consider selling off half of that SCHD right now, especially since it is a little higher in price. It's trading a little higher. I would consider putting that in a SPY or VOO. Just 15%, you could just leave it there. So I think that's a potential option. You could go 17.5, whatever you'd want to do. I would potentially consider that. But I think definitely SCHD is going to have a little bit of pain in the short term as they are kind of reconstructing their portfolio towards a little more high growth, which I think long term is the best option for them. I'm hoping that long term they can continue their dividend growth that they've been on recently, but I would possibly consider the SPY or VOO thing. Alright, next we have Apple coming at 2% of the portfolio, which I think you could have a little more room to increase your position there. I understand that Apple has a crazy valuation according to all the analysts, all the other investors, but I think now, especially with this Apple dip, now could be potentially a good time to kind of build up that Apple position. Obviously, I know you're more dividend growth oriented, Apple's dividend growth is nothing to write home about, but they are rewarding you definitely with those share buybacks. You're owning more of the company over time, and it's just a high quality company. I think as Apple matures, maybe over the next 20 years, they could potentially start rewarding you more in dividends. So I would definitely consider adding up that Apple position, possibly making up 10% of the portfolio. I didn't see a whole lot of, core positions here. I only see two, maybe they're at like the 5 or 10% range. I would definitely consider making Apple a core position regardless of the slower dividend growth. I love Apple so much as a company, and now could be a great time to potentially add more. Alright, next we have Johnson & Johnson making up 2.9% of the portfolio. I like this holding. J&J is obviously a stable. They aren't going anywhere at all. I would have personally liked to buy some more in the 150s when they had that bit of a dip. I'd hope its performance has been nothing crazy recently. It's kind of been trading in the 160s, 170s for last couple of years now, it seems, but definitely a staple of a company that will ensure to continue paying and growing their dividend at a stable rate. Alright, next we have Coca-Cola making up 2.8% of the portfolio. Coke is kind of in the same range. Capital appreciation wise, I think it is kind of, I have questions of where they can kind of grow. With that said, though, they are a staple of a company. They aren't going anywhere. They have a monopoly, basically, over the beverage market. Them and Pepsi's payout ratio has been on the higher side right now. My big red flag right now with Coke is definitely the valuation. If you're bringing it $63 a share with that, 27 Ford P or whatever they're at right now, it definitely, I have questions of where they're going to, you're going to get your growth from there. I'm not fine with, underperforming the market if you're buying it at 25p for a company like Coke, with it only has limited growth, really. Coke's a solid company, but it has to be at the right price. I'm just reinvesting my dividends for that one right now. Speaking of companies at a good valuation right now, next we have Altria making up 3.5% of the portfolio, which is a really good area right now, I think, for Altria. Altria is one of those companies. It's a very strong quality company, but I don't know if I'd like having it as a core position simply because of all the risks they have and the underperformance of the market. With that said, though, they do provide a really solid 8% yield right now. They provide stable free cash flow, and that dividend looks sustainable as of now. Every time I walk into the bathroom at school and I smell smoke from a vape, I just hear cha-ching in my mind from that Altria dividend. I think Altria's business itself and its actual fundamentals are very undervalued and overlooked, and I think it's at a relatively attractive valuation right now, under $50 in those low 40s. Alright, moving on, we have a very high quality company, arguably the highest quality company in the world, Microsoft, making up 11.4% of the portfolio, and this is what I like to see. I like to see companies like Microsoft making up 10+% of the portfolio. I like where this is at right now. I have Microsoft making up around that same range in my portfolio as well. For me to seriously consider start adding again on this little dip that they've had in quotes, I'd like to see it at 280, 270, and I'd consider start dollar cost averaging back in. It's that strong of a company. Moving on, we have Realty Income making up 5.4% of the portfolio, and I'm a big fan of this holding. Realty Income's really starting to get to an attractive price again, getting near $55. Hits that 55 range, I'll definitely consider dollar cost averaging back down again. I think that's a very solid value for Realty Income. I know a lot of people talk about, Realty Income and how they're a dividend play, but really they have some strong properties, strong tenant base as well. It really is eager to do well in a recession. Definitely like that Realty Income position though, and I'd like to see those dividends being reinvested and potentially adding some of these lower prices. Alright, next we got Omega Healthcare, and I'm no expert on this one, but from what I see, they have a high dividend payout ratio right now. It looks a little unsustainable by the current 242% payout ratio. I'd have to do, obviously, further more research on that. Right now, from the current financials, they have a lot of debt and some share dilution. That dividend kind of seems like the last threat of the company, which I'm just not a huge fan of. So from a quick glance on that one, I'm not a huge fan of that position. Speaking of businesses that I'm not a huge fan of, we have Verizon, which is next, makes up 1.2% of the portfolio. Now, thankfully, these are some smaller positions, but obviously Verizon, you guys, I think it's the better option than AT&T. With that said, I don't like telecoms in general. A lot of underperformance, a whole lot of dividend yield, not a whole lot of dividend growth. Not a huge fan of that one. I'd like to see you sell out of that potentially in that Omega Healthcare and potentially put in some higher growth position, maybe Apple. I know you're going to be losing a lot of yield on that, but I think long term it's worth it. Alright, thank the Lord we have a better company next, which is of course Vici, stock ticker VICI. That makes up 2.8% of the portfolio. You guys know my thoughts on Vici. I'd like to see Vici up near that 5% with Realty Income. I think that would be a really nice double play right there. Kind of, you got Realty Income, which is more of a stable, going to provide you with that consistent dividend every month, and you have Vici which offers yield as well, but I think it offers you a lot more growth as well in that real estate sector. Vici's diversifying out of Las Vegas, and I'm liking what they're doing right now. Alright, next we have Bank of America making up 2.2% of the portfolio, which is obviously kind of a Buffett holding. Looking at Bank of America's financials, you guys already know I don't invest in banks in the first place because I don't fully understand their business, but right now they're negative in free cash flow and things don't look too good for them financially. They have $286 billion in debt. Now, I don't know if like banks carry more in debt or whatever. You can correct me on that. But for a bank play, I'm not a huge fan of Bank of America, just looking at their financials right now. If I were to buy a bank, it would definitely be JP Morgan. They also did just hike their dividends, so props to them, and they have a really healthy payout ratio, just looking at it from the numbers here. So, I mean, I'm not totally against this position, but I don't love it at the same time. Alright, next is a holding that I've been looking to add for a while, which is Domino's Pizza, stock ticker DPZ, making up 2.2% of the portfolio. Domino's is a company that I think will benefit with robotics and automation, all that good stuff. AI even. I like Domino's a lot as a company, and I've been looking to add it for a while. If it gets down to like the 360, 370, I'm going to consider buying. I view Domino's as a half pizza, half technology company, and I think it's going to be valued a little higher because of that. Domino's really pioneered online delivery and all that stuff, Uber Eats, all that. They really pioneered it. They were the first restaurant company to really do that, and I think they'll continue to innovate and grow their business along with it. And I like Domino's a lot. Alright, next we have Lowe's, making up 3.1% of the portfolio. I like Lowe's a lot. Very strong dividend growth company, and I approve of this position. Alright, speaking of banks, we have JP Morgan making up 1.7% of the portfolio. I'd prefer you possibly sell it at Bank of America, put it into JP Morgan. Just looking financially, it looks a little better. Alright, next we have JEPI making up 1.4% of the portfolio. I'd hope this is a short-term position, just kind of bringing in some income that you can reinvest back into some higher quality positions. But not a huge fan long-term of this, but I guess in the short term, if you're just storing some cash in there, trying to get some yield right now, put it in some higher quality companies, build up that dividend income, I would approve of it short term. Next, we have Visa making up 1.6% of the portfolio. Now, you guys know me. I love Visa so much. It's one of my favorite companies to invest in right now. Right now, I'd like to see it building up that Visa position a little bit. I think it deserves to be in that 5 to 10% range for sure. I would definitely like you to consider building out that Visa position for sure. Visa is such a high quality company. I know they don't have the biggest dividend yield or whatever, but their dividend growth is nuts. Such predictable free cash flows. They basically run a duopoly on the payment processing industry, and they're going to be around forever. Love Visa. I'd love to see you build it up as well. Alright, next we have Texas Instruments making up 2% of the portfolio. Texas Instruments is a company that's been on a bit of a dip recently, and I'd consider possibly adding. Their financials are strong, they do buybacks, and also have a really solid growing dividend. With that said, though, I don't completely understand their business myself, so I'm not going to be buying just yet. Alright, next we have Caterpillar making up 1.2% of the portfolio. Very strong quality holding here. Caterpillar is a company that is just soared in stock price over the last couple months. Next, we have T. Rowe Price making up 1.1% of the portfolio. Another solid holding here. Obviously, they're being discounted a little bit right now, but just hit a huge spike in price. I think T. Rowe is a very cyclical business. I think long term, as the market goes up, we'll be fine for that. Next, we have Broadcom making up 2.9% of the portfolio. I like Broadcom. They're a very strong company. I think Broadcom's the best way to get really exposure to semiconductor growth. I think they're a non-fabless company, which is really the best thing over them, or like a company like Intel or AMD. Next, we have Jefferies Financial Group, and they have a solid growing dividend. I don't know much about this company overall, though, so I'm not going to give my full opinion on that. And lastly, he owns MPW at 0.8% of the portfolio. I'm not a huge fan of MPW. A little bit of a speculative position there, but I guess it's a very small holding, and it has a high dividend yield right now. Taking those dividends from MPW, reinvesting them elsewhere, I think that's a solid option. Alright, which of these stocks would I consider selling off right now? Obviously, he's trying to consolidate. I would consider selling Coke. They're a bit high valuation right now, but I would buy back into Coke if it got to a reasonable valuation. I do think it's a really good company, a solid valuation. It has to be good valuation, though. With Coke right now, you could sell right now, potentially take some gains, and maybe be able to build up that Visa position, which is, I think, more of a fair price. Both are trading at the same forward PE. I would consider selling out of Omega Healthcare. They just don't fundamentally look like the strongest business. I would consider selling out of Bank of America, maybe reallocating that into JP Morgan. Consider selling JetBay. I wouldn't love that long term. It's obviously a smaller position. I would consider selling possibly Jefferies as well and MPW, but those are very small positions. Those are the companies that I would personally consolidate to. And of course, maybe sell out a half of that SCHD, put it in a SPY or something. What are some companies that I'd like to see built up? Apple, as I mentioned, I'd love to see that a little higher. I'd like to see Vici higher. I'd like to see Visa higher. And don't think I forgot about Verizon. We're, of course, going to consider selling out of Verizon as well. Alright, guys, those are my thoughts. So my overall grade on the portfolio, I would give it an 8.3 out of 10. I think his portfolio is very similar to mine in the fact that we both have a lot of holdings at smaller positions. Some of these holdings I definitely would like to, be sold out of potentially Verizon. But in all seriousness, very, very solid portfolio here. I think with some consolidation over the long term and more focus towards dividend growth, this could be a very, very staple of a portfolio and a compounding machine. Again, thank you to Dividendology for allowing me to go over his portfolio and showing complete transparency. Honest to God, he's one of the biggest YouTubers out there right now in the dividend-focused community, at least. It actually shows transparency. Again, guys, if you appreciate the transparency from all sides of the spectrum here, make sure to hit that subscribe button on this channel and Dividendologies. Check out all of his links, link in the description, and of course, do dividend stocks, not drugs. Have a good one.